Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is real estate investment expert Travis Balcomie. Now, Travis is the founder and CEO of Balcomie Capital, a boutique real estate investment firm focused on self-storage investments. He is the director of overall investment strategy, asset acquisitions, and business development activities. Now, prior to Balcomie Capital, Travis was the CEO of the largest privately owned distressed house buying company in the state of Texas, known as Texas Trust Home Buyers. And so with that, it's an honor to welcome Travis to the show. Travis, how you doing today?
Doing good. Thanks for having me, Kevin.
Excited to have you here, man. Excited to learn about you and your business. And we can talk a little bit about the economy as well, given that it's all doom and gloom in the headlines. And so, but before we get into all the fun stuff, maybe Travis, if you would, I give you such a very brief, shortened introduction there. Take a few moments. And, you know, for those that aren't familiar with you, that don't know your story, your background, take a few minutes to tell us a little bit more about yourself.
Yeah, that was a great introduction. We primarily are self-storage investors at this point. We do single asset syndications for each storage facility we buy. Before that, in 2012, I bought my first house. I had it rented out before my first mortgage payment was due, and I thought that was pretty cool. So I tried to buy as many houses as I can. We ended up buying about 400 houses from the time frame of 2015 to 2018. After being run ragged from buying so many houses, I decided there had to be a better option to generate wealth and generate an income, and that's how I discovered self-storage. So that's how we made the transition to what we do today.
Okay. Well, let's maybe explore that a little bit more, just kind of the background in the single family, and then we can talk about maybe the transition and more so related to self-storage. But so about 400 houses, you bought that first one, thought it was pretty cool. You made a little bit of cash flow with a renter in place, and then basically bought almost 100 houses a year for a number of years. What was the overall business strategy, with that prior model? Was it to buy and hold everything, or were you fixing and flipping a number and then just keeping a few, or what did it look like? Just get a better understanding there.
Our goal was to buy one for every other one. We'd buy a house, flip it. That would juice the back end office that was allowing the vehicle to buy these houses, and then the next one we would try to rent out. Unfortunately, in order to buy that many houses, there's so much operational requirements that you had to hire a good amount of people. We had 9 people working for us to buy that many houses, and so we had the back end office had transaction coordinators. We had I had one lady who her whole job was to make sure insurance was active and also rents were coming in. There was so much going on that we had to manage kind of minutely what was going on, because one house has when you're renovating a house, has 110 things you have to think about, and then when you rent it out, you have about 15 things that could go wrong on average. AC could go out, plumbing could go bad, foundation, roof, hailstorms, all that stuff. All of that takes time to manage, and so you had to have a pretty big office. So because of that, we ended up having predominantly most of those ended up being flips. Our goal is to have 300 rentals, and we only got to 72 before I would say the machine broke. And so by the machine, I mean like we just ran out of money. We were just going too hard. We were buying too many houses. We weren't disposing of those houses, and we couldn't make payroll, couldn't make interest only payments to our bank and to our hard money lenders, and that's why when I said I was ran ragged, I was like, I'm so tired of this, I'm burned out. But in October of 2018, I had to let everyone go. I had like 40 renovations going, and I had 72 rent houses, and I ended up having to work with lenders, work with partners, just to process all that. And I'm glad to say that no bank ever took a hickey. Like, they got paid exactly what their principal was, along with their interest, and none of our hard money lenders ever took a loss or a discount on their interest payments. And so, but a lot of that was because they knew, I had one hard money lender. He was a guy, just a single guy with some family money. He had 28 loans with him when everything fell apart. And so I'm just thankful that he was able to get paid back. interest payments were able to get paid back. And like still today, when I do my one-off houses, occasionally I'll buy a house in a certain area or something for just kind of a hobby. He still lends me money on it. And so I have a good relationship with that. The same bank that had all my rentals and the hard money lender. We still have really great relationships with our lenders and partners. But it was not easy. It was very painful, especially that first few months of trying to get everything situated and figure out where all the houses were. I was driving about 1,000 miles a week just to try to cover everything because we had houses in 47 different cities in Texas. It was just ridiculous how absurd that is. Now that I think about it, hindsight.
How many different cities?
47 different cities. We had bought houses in that many different cities.
How many counties? What like how many? Give me the the sheer size of what that means.
So I'll tell you this. I live in Waco, Texas, which is centrally located in Texas. We had a property in the Panhandle, which is 8 hours away. We had property at the border, also 8 hours away. And we had this system that we were buying houses kind of sight unseen, but we'd pay someone in Craigslist to go look at it and take photos and send it to us, and then we'd find a GC. And that was working until it stopped working. You know, it works really great until someone takes advantage of us, and then we're forking over $20,000-$30,000 extra on those renovations, and that's all profit that's supposed to go towards payroll and that sort of thing. And so it was just, we got too big, we were trying to buy too much, and because of that, I just we ended up shutting it down because I knew I had a problem.
What do you think it sounds like there was a number of maybe structural problems with the business model, but you and I both know, we know other people that is their business. They've been doing a long time, and I don't know, it looks like behind the scenes, I'm sure there's plenty others that are having struggles, but others that have figured out whatever works well for them, right? Internally, they figured out like a good system that works for them and it's profitable. But what do you think? What were like the top like two? After kind of looking back, and I don't know if maybe you haven't gone through a reflection period. My guess is you probably have. I did the same thing when I went through '08. Reflected back on my single family portfolio and just some of the struggles we had after the Great Recession, and how do I not go through this again? How do I rebuild the infrastructure better? And so what did you identify as like maybe the top two critical items like that just really caused the things to come unraveled? Because ultimately, like we're talking some of the peak years of real estate, right? Like values are just climbing like crazy. And high demand for affordable housing, high demand for rentals. And so it surely wasn't that the demand wasn't there, that you maybe were losing equity or the homes were going upside down in value. So what were the big two things that if you could go back and do it all over again, you would have done differently?
Yeah. And given the time frame, I think that's why I was able to get out of it. We bought well. We were able to get out of properties for either what we were in it or slightly above that. But I would say the two things that I would do differently if I were to restart is on day one, I would hire a COO or an integrator. If you read the book Traction or Rocket Fuel, it talks about there's a visionary and then there's an integrator. And I am absolutely a visionary. I'm probably one of the most visionary people out there. And I would need to hire an integrator for me to run that business successfully. And an integrator is essentially, for those that don't know what that is, that's essentially someone who is operationally efficient. And I wasn't. And so I would basically, they understood, visionary is like, this is where we're going, but I don't know how to get there. An integrator is someone who's like, oh, I can come up with the processes and the procedures and the systems that help us get to where you want to go. And I didn't have that. I tried to hire it several times. And ultimately I was just trying to figure it out on my own. And that was a pretty big disaster because, and I would also say the book, one of the books that there's two books that really spoke to me during that time is the Five Dysfunctions of a Team by Patrick Lencioni. I read that. I'm like, yeah, all five of those things, we scored 100 on that. And then a book called Principles by Ray Dalio, one of the most successful hedge fund managers ever. And I came up with one of my principles of if I get out of this, this is what I'm going to do. This is how I'm going to buy assets in the future. And it was like for asking me every day, every week, or every month. And that was and that's basically how I've built what I have now, is because I just focused on if it's cash flowing, it doesn't even have to be positive cash flowing, but if it's making money, where it's covered the mortgage or has potential, that I'm going to buy. That's something I'm going to buy. So that eliminates all flips. It eliminates any speculative buying at all. And because of that, I've never gotten like in 5 years, I haven't gotten a pickle like I had previously.
Yeah, no, I appreciate that. And I appreciate you being vulnerable and sharing, some of the challenges that you had. And ultimately, we all have challenges in our business as we grow the business. And my guess is that, here in the next, year or two or three, however long, this downturn lasts, there's going to be more cracks that come to the surface. We'll see other groups that might not have everything really put together, glued together behind the scenes as much as it might look like from the outside, looking in. But again, wish everyone the best. But again, everyone's got challenges as they grow their business. I'm glad to hear that you were able to get out, pretty much unscathed, and have some reflection time to look and see, okay, here's what I did wrong, and here's ultimately what I intend to do differently the second time around. So let's talk about the second time around. So you decided on self-storage investments, which I love the asset class. And so, we don't need to go into details as to why. I think we've talked about that a lot on this show. It's just a phenomenal asset class and huge demand. But what I would love to know, just given the time frame that we're in the economic cycle, what does, I guess the simple question, how to start this would be, like, your business, what did it look like, call it 18 months ago, compared to what it looks like at present time? Have there been any pivots made? Have you adapted? Have you shifted the business model whatsoever? And if so, what does that look like?
Yeah, 18 months ago, we were pretty bullish on the market still. Rates hadn't really increased. They didn't start increasing until about 14 months ago. We were still getting properties under contract for, 5.5, and we were belly aching about it. We were like, I can't believe this is so expensive. Like, you guys are taking advantage of us, and we were still buying. And then slowly the last property we bought was in November of last year, and we haven't bought anything since then. And it's not because we don't want to. We've submitted probably 50 letter of intents. The reason why we haven't got any to be accepted is we don't think the market's going up anymore. We feel like the roller coaster train has gone over the peak. That was probably 2021, and it's starting to go down. And we don't really, in the storage industry, or at least our facilities, we're not planning on increasing rents unless the market says we can. And so we have a facility that rents are currently at $7.90 annually. Market's saying $12. We're going to slowly trickle that up over the next 12 months to get to that $12. But at the same time, if we get any pushback from our tenants, meaning basically it's the storage industry, that means people are going to move out, we're going to stop raising rents. And so several of our other facilities, we stopped raising rents. We feel like we're going to be able to maintain where we're going, but at the same time, we don't think, we're not very bullish on increasing in value, because every month Jerome Powell adds a 25 basis point spread, and that means, every time interest rates go up, that means values go down. And so we don't even know what our properties are worth at this point. I don't think anyone in commercial real estate says this is what my property is worth. They're lying to you, because they don't really know, because it's all whatever someone's going to pay for it. And if they're borrowing money at 8%, it's going to be a lot less of what they would have paid for it, 18 months ago. And so we've just been real careful. We want to make sure that when we buy, there's a very short time of negative cash flow. And so we want to make sure that within 3 to 6 months, or if we're doing an expansion, it would be 12 to 18 months of negative cash flow. We want to make sure we have twice that in reserves. So if it's supposed to lose 150 grand, we want 300 grand in reserves just for that section, not talking about the rest of the reserves that we typically do. And we just want to be incredibly conservative on the operations side as we move forward, until we see some sort of uptick and change in market. And right now it just does seem like it's going down, but it's going down so slow. It's really hard to kind of pivot to going, okay, well, this is exactly where it's going. This is where we need to offer offer. This is where we need to make offers. It's really hard to figure that out. So we're just, ideally, we would like to buy a facility that's making money right now, but the market's still pushing that a little bit. So when you're buying a facility, it's losing money for the first 3 to 6 months until you raise rents. Yeah. Which is a great thing about storage, is you can raise rents every month, because it's a month-to-month lease.
So I would love to, let's dissect that a little bit. So, you bought your last deal November. You've been writing offers. We do the same, and we've only purchased, I guess one asset or one asset this year thus far. And have a few others that two others that will hopefully close here in the next month. So, but I don't know what the rest of the year looks like. We make a lot of offers and kind of the same thing. We experienced something similar, but would love to ask you the question. Would love your perspective on, those 50 offers that you've written that ultimately you were selected on, you weren't chosen for. What do you think the buyers that were awarded those deals, like, how does their business model differ than yours? Like what might they be doing? Are they just wearing rose-colored glasses, or do they have maybe a strategic advantage that maybe you don't have? I don't know the answer, and we deal with the same thing, but I would love to hear someone else's perspective on exactly what you feel is going on in the market.
Yeah, we've asked brokers like, hey, why did the seller go with another offer? Why did they do this? And the most common thing that we're seeing is they had low leverage loans, or they were paying cash. And so as of today, we had an incredible deal in Tulsa, and our offer had a 65% loan on it, and the other offer that we were competing against was a cash offer. And so cash is pretty secure. If I was selling one of my facilities, I would absolutely take the cash offer as opposed to
so they might not be paying a higher price. There's no risk of a debt issue coming up like midstream that might kill the deal. Is that I guess that where I was going is like a lot of times what we experience is like we get beat out price wise. It's not necessarily from debt terms. It's more of like there's maybe a decent delta from like where we underwrote it, where it made sense to where it actually traded for. That's kind of what I was thinking of, maybe why you're missing out, but it sounds like it might be slightly different. It might be you guys are in alignment with price. It's just your debt might not be as safe to the seller, in the seller's eyes, as someone that's coming in and paying all cash and doesn't have that the debt risk.
Yeah, that's essentially it. On that one, I think they took a cash offer and it was less. And the reason why our offer was higher is because it came with 8 acres of expansion. We were going to do 5 acres of RV and boat, and we were going to do another 40,000 square feet of climate control. And it was in a market that was underserved. It only had 4 square feet per capita. That market is balanced around 8.5. So we knew that we had a really good gym. And so I think the reason why it took them so long to make a decision is our offer was higher, but our offer had a financing contingency and that sort of thing. And the other buyer didn't.
Have you noticed any downward trends in the overall occupancies of your storage units? I mean, I saw some national data in the last couple of days through one of the subscriptions I have, and I know that national data it skews it a little bit because ultimately every market's in and of itself, right? Every market kind of lives and breathes differently, but just generally speaking, your portfolio, have you noticed any downward trends as far as average occupancy? And I know a lot of self-storage, a lot of folks that store things, some of it or a good portion of it's tied to, folks moving residences, and obviously transactional volume was crazy in the last 4 years, has slowed quite a bit. People aren't moving as much, trading homes up or down, what have you. And so have you guys noticed anything within your own portfolio as far as occupancy trends?
Yeah, like I mentioned before, we're real careful on rent increases and even get rent discounts. We don't, if we have a tenant that's behind, instead of being really aggressive on kicking them out, we give them some time now, which is a big change from what we were doing. We have seen like the facilities that were like always 100%. Those have come down to low 90s, high 80s. A storage, most banks consider a storage facility to be stabilized at 85%. If you look at national data, I think in 2020 to 2022, it was like 97.5%, I think, occupancy, and that's down about 300, down about 94, 92%. So we're trending similarly with what the nation is doing, or with what the other 55,000 storage facilities are doing in the nation. Okay. So to answer your question, yes, absolutely. But it's not that. So it's just not crazy bonkers anymore. It's just like it's actually healthy occupancy.
Is there a risk? And again, every market's a little different than the next, but there's little bit less of like, just I guess comparing self-storage to mobile home parks, that we're in that space, and there's a pretty big barrier to entry with mobile home parks because just they're not being built. There's not a lot of new supply, if any, coming on the market. For a litany of reasons. We don't have to go into that now. Self-storage is different. Self-storage, there's, lots of new development happening across the board, both, smaller groups as well as regional and national groups. Is there a risk maybe in the markets that you guys are operating in to where, some of the, new developments that haven't yet come online might impact those occupancy numbers even more to where they might dip down over the next couple of years? Or do you guys keep an eye on that?
We do. That's definitely a threat. I would say two of the markets we are in. One of the markets we're in, there was another storage facility added, and we definitely saw some issues there. However, but with that said, we're still way up on revenue, year over year.
Yeah.
The occupancy is way down, and then another market we're in, we're having some issues filling some stuff up for what we projected the rents to be. But another thing, again, it's $12,000-$15,000 a month higher than what we bought it for, and we still have quite a bit of room to grow on that as far as occupancy goes.
On that first example, like when another competitor opened up, I don't know how far away it was from your facility, but how immediate is like that impact? And I just think of like I haven't rented a self storage space for many years, but back when we had one, I remember paying rent for that thing for years when we didn't even need it anymore. I just didn't feel like moving. I didn't feel like even dealing with moving the stuff that was in there. Just was stuff that we weren't going to use anymore, and it was easier just to pay the payment than it was to even mess around with moving it or trying to sell whatever was in it, what have you. I think at some point in time we just let it go. We stopped paying. It's like let them auction it off, and just I'd rather not spend the Saturday or hire someone to go move it. And so I guess the question, back to the original question of like how immediate is the impact when a new competitor opens, like within a decent proximity of you? Is it right away? Does it take a period of time for that all to play out? And then I guess lastly, why would someone choose to leave your facility and go to theirs? I mean, I could understand like maybe a month free or 2 months free, but aside from that, it just, if they're in line with the same price point, it just seems like such a headache.
Yeah, everyone kind of has a similar take on it as you do, as far as like, man, I don't want to take my Saturday out to move my crap that I don't really want, but I don't want to throw away. The thing that we've noticed is if we're too aggressive in raising rents, we'll lose tenants to the new guy,
Okay.
especially in what I'd call like an unintelligent market. And I'm not referring to my tenants on that. Like if you have a rural market where a guy's main job is putting metal buildings together, that's a pretty big threat, because he can throw up a facility for substantially cheaper than ours. And then if he's charging $50 for a 10 by 10, we're charging $67 plus $9 for insurance. That's in a smaller market with a low income, with a low average income, that's definitely an issue. The one facility we have that's an issue, and it's for sale right now. We're going to get rid of it because I don't foresee it getting better. And and that's, when it comes to our underwriting criteria, we've definitely added that to the list of that we do not buy in markets that have a declining population. We do not buy in markets that have a average household income of less than 65,000. And this market does both of those things, and it's clear that those two things are really bad for storage. And but yeah, it can happen. Like if you like on that one, we raised rents in March, and we raised rents in July, and then we raised rents in I think September, and then we forced place insurance in December. So we were way too aggressive. If we didn't,
Oh wow, yeah, that is aggressive.
if we would have cut that to like once every 6 months, we probably wouldn't have lost that many. But the reason why we were increasing that much is after the first 20% increase, we lost 0 tenants. And so we're like, well, there's just more room to grow here, because I knew the other 3 facility owners and they were full. And then this guy I didn't know, he had planned to build some units I didn't know about. And then because they weren't in the zoning department, they weren't, he just kind of one day just decided to build them. And then yeah, so if the second time we did it, we lost a little bit, but it was still like 96% occupancy. So the third time we lost like 10%. That's when I knew we were probably close. And then my insurance company was like, you have you have to provide 395 hazard and GL policies for every tenant. They have basically they have to provide their own housing policies to us, or rent policy to us. I was like, well, that's not going to happen. They're like, well, the only option is for you to force place insurance on them. And so that's what we did, and it ended up being an additional $9, which was like a 15% increase. And so
Like the final slap in the face.
yeah, we don't use that insurance company anymore. So because that's that hurt quite a bit. And so that's why we lost so many tenants, and we're just not going to do that again. We're going to be a little bit more respectful to our tenants, really.
What are some of the other data points that you guys look for as part of your acquisition criteria? So you just mentioned like net, you won't look at markets now that have a household median income under 65,000. What were there any data? Give me like, how about like minimal population in a 3 to 5 mile radius of the facility? Any other demographics that are relevant that are kind of like green is go or red is stop? Like if it doesn't check all the boxes, we're either buying or we're not buying.
Yeah, we have a few things we look every time we get an offering memorandum from a broker. We tend to take a look at it, and if the other facilities, if the subject property is full, that's a real popular thing for us. Like, we really like it, so we'll move on to the next thing, which is calling all the facilities within a 4-mile radius and seeing what their occupancy is. And if those are like 1 or 2 units left, or if they're completely full, that's a positive thing. The other thing we look at is it needs to have an increasing population. So the population year over year is growing over the last 10 years. So there's not like a negative. People aren't moving away and not coming back. That's probably the most important one, because people moving to town, they're buying houses, and people buying houses is a good thing for storage. And then we want to make sure that I would say the least demographic, but we still look at it, or least important demographic, but we still look at it, is the per capita of storage square feet to population. So we want that to be somewhere around 7 or 8. However, we'll scratch that whole thing if every facility in that town is full. And so those are the 4 things that we look at.
How about unemployment rate? Is that relevant?
We definitely want like 5 major employers in that market. So like someone like typically the ISD and the municipal government will be 2 of the main employers on some of these smaller markets, and then we want 3 other major employers. So like the grocery store, or something like that. And then obviously in a bigger market like Oklahoma City, where we have a facility, we've got there's massive amounts of employment. Sure. So we don't worry about that. But we don't really look at unemployment as much. I would say if a lot of those cities, like Detroit, for instance, we're probably not going to buy a facility in Detroit because of the historical reputation of Detroit being just a town that doesn't, a lot of cities in Michigan that just don't have any economy anymore. Rural cities out in West Texas, we don't want to be a part of. But with that said, if there's lack of jobs, people are going to move, and so therefore there should be a declining population. And so by looking at the declining population, it kind of eliminates needing to look at unemployment rates.
Yeah, no, understood. So I guess, what does the rub the crystal ball? What does the next 12 to 18 months look like for your organization?
Yeah, we're selling some of our bad apples, like I said, some of the ones that aren't performing well. We had a entitlement that we were going to build a new facility on, and I just got scared, and so I ended up selling it to another developer that had a fund that could pay cash, and it was a great deal. I just was going to have to leverage it, and I didn't want to take on a $13 million loan coming into a recession with an 8%, which was like $100,000 a month payment. And
most of those most of the loans you guys are getting on self-storage are full recourse loans, correct?
Yeah. That would have ruined that would have been in for me if that didn't work out. So a little too much risk. Don't want to take on that much risk right now. So I sold it to a great company that I really appreciate. And then so we're probably that's a pretty good amount of money. We're probably gonna sit tight and just really wait for the best. Like, we're gonna still submit letter of intents if we get one approved. That's great, but really focusing on the marketing and the capital raising side right now, so that when things are down and they start coming back up, we can really hit it hard and really make an impact.
Are you guys, for the most part, finding your opportunities through brokers, or do you do your own, off market efforts as well?
Yeah, it's primarily through brokers, but we try to create relationships with those brokers as opposed to just calling them and asking them questions. We really like, if they're within a driving distance for me, I want to go and have lunch with them and just get to know them. People like to do business with people that they like, and thankfully I tend to be a person that people like. And so I'll call and say, hey, I need to buy like I had a conversation with a broker today. I'm like, I need to buy a $4 million a self-storage facility that costs $4 million because I'm going to have about a $200,000 tax liability. I need to eliminate that with the cost tag. Do you have anything off market you can help me with? And that makes them start going, okay, this guy's a buyer. If I can find a $4 million facility that's off market, someone I've been talking to, I bet I could get him to buy it, and I can make a nice fat commission. And so we really want to work with our brokers and really get to know them. We want to know what their birthdays are. We want to know what type of, if they have a family, if they have kids, this sort of thing. And the reason why is we just want them to like us a whole lot. That's really it. And so we primarily work with brokers. If I'm driving somewhere and I see a facility, there's a good chance that number that's on that facility is the owner. I'll call that number to see if they're wanting to sell, that sort of thing. We haven't had a lot of luck with that. Most of these owners know what they have. And they really enjoyed that passive income. Even like, in one market that we own most of the facilities, there's a gentleman who's like, man, he's got to be pushing 90 and he doesn't want to sell. So I'm like, Mr. Glassman, man, you should really think about this. But yeah, it's, there's typically through brokers and relationships. I'm a big relationship guy. I just want to do business with people I like, and I think people want to do businesses with people they like, and so we're just trying to connect those things.
Okay, no, I appreciate that. Well, Travis, for those that want to learn more about you and your organization, where's the best place for them to track you down?
Yeah, there's two places you can reach out to me. We post videos on Instagram at Travis_Balcomie. That's BAUCOM. And then you can also go to our website, which is investinstoragedeals.com. And if you scroll to the bottom of that website, there's a form you can fill out, and we'll send you any deals we have in case you're interested in passive investing.
Okay, well, fantastic. Well, Travis, I appreciate you joining us here today. It's been a lot of fun having you.
Yeah, thanks, Kevin.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bubb, wishing you huge success. Take care.